Hi, I'm Dr. Cheryl Dunn, and I'm here to demonstrate an introductory financial accounting problem about inventory costing in a periodic inventory system. Take a look at the problem. As you can see, I've copied a lot of the information that was given in the problem, and so you can see the beginning inventory that we started with plus the different purchases during the year. And it also told us that we sold 10,500 units during the year at a selling price of $50 each. And then I made a table for what the problem asks us to find. It asks us to find the inventory for the balance sheet at the end of the year, as well as the sales, the cost of goods sold, and the gross profit that's going to go on the income statement for the year. And they asked us to calculate those under each of the three different periodic inventory system methods. First in, first out, what we call FIFO, last in, first out, that we call LIFO, and the weighted average unit costing method. First, we realized that the dollar value of sales for our income statement doesn't depend on what inventory costing method that we use. We simply take this 10,500 units at $50 each, and we recognize that that is $525,000. And that's going to go on our income statement as sales, no matter what costing method we use. And that's because the sales is an economic phenomena that we know the value for. There is no need to try to estimate it or make an assumption about it. We know how many we sold, and we know what we sold them for. There's no guesswork involved. We simply take the quantity sold times the unit selling price. That gives us the sales dollar value. And so that's going to be the same under each of the three methods. We also can calculate how many units we have left. The number of units also doesn't depend on the method that we use to assign costs to those units. We know that we started with 850 units. We know that we added these different quantities of units during the time period, which gave us total available of 11,700. The units available minus the units we sold should equal the units that we have left. And that's what we would refer to as being in our ending inventory. Our job in this problem is to assign cost values to this 1,200 units that we have in our ending inventory, as well as to the 10,500 units that we sold during the year. Here's where there is guesswork involved, because unless we have a sophisticated enough information system to be able to use specific identification and know exactly which items we sold on each sale, we don't know exactly which items we sold. So we make assumptions about which ones they were. Under FIFO, we assume that the first ones that we got in were the first ones that we sold. And that means that the more recent ones that we purchased are the ones that we would have left at the end. Under last in, first out, we assume the opposite. It's kind of, imagine like we have a coal pile and we're selling off the top of the pile. So the most recent ones that get added on are the first ones that come off and get sold. Under a weighted average unit costing, we say, oh, we don't know, they all got mixed together. We don't know for sure, so we're just going to say they evenly came from the different purchases that were made. So let's take a look at what it's going to look like calculating our ending inventory and our cost of goods sold using each of those three methods. You can see that the cost of goods available for sale, the $271,400, basically we're trying to separate that into what portion is left and what portion got sold at the cost value. We're not really thinking about the revenue value when we're thinking about this cost of goods available, but we're trying to basically split this into two pieces. What's in our ending inventory, that's going to be what's on our balance sheet, and what is our cost of goods sold. First, let's use FIFO. Under this method, we assume that the oldest items were sold, the first in was the first out, and that the newest items are still on hand. So the 10,500 units that we sold consisted of First of all, our 850, so let me write FIFO here. We would start with that 850. That cost us 22 for the total of 18,700. And then we would assume that we sold the next 2,000 at the 23, that cost us 23, for the total of the 46,000. And then we would assume the next ones we sold were the 2,400 that we paid $23.50 for a total cost to us of the 56,400. And then we would assume that we sold the next 3,000 that cost us $22.50 for a total of 67,500. And then we would assume that we didn't sell all 3,450 of these. We still have 1,200 left. So if we take the 1,200 away from there and assume we have those left, that means that we would have sold 2,250 of the ones that cost us $24. And that would give us a total of $54,000. If we add these numbers up then, that would give us our total first in, first out cost of goods sold of $242,600. And so we would write that up here. And notice then we can calculate our gross profit. Our gross profit is simply sales minus cost of goods sold. So if we subtract the cost of goods sold using FIFO from the sales, we're going to get $282,400 as our gross profit. Now let's look at what our inventory would be. These were the items we sold. The first in, first out ending inventory then is going to be our 1,200 units that we have. They're all going to come from the most recent purchase, since the recent purchase was big enough that they all could be part of it. And so we're going to take that 1,200 times the $24 that we paid for each of those, and that's going to give us $28,800. Now, it's important to double check to make sure we did our math right and didn't make a silly mistake or accidentally punch a number wrong into our calculator. It's always important to double check to make sure that whatever we ended up with and what we sold add up to what we had available. And so we want to sum this plus this to make sure that it does equal, and in this case we can see that indeed it does equal $271,400. So our ending inventory plus our cost of goods sold equals our cost of goods available for sale, which is what it should equal. By computing each of these separately, rather than just taking the total goods available and subtracting the first one we calculate, we can catch errors that we might make along the way. So I recommend that you use that approach. Okay, so we would write the ending inventory in here of 28,800. And then we basically repeat this process, but somewhat backwards, for the last in, first out. The last in, first out says that these latest ones that we got in would be the first ones that we sold. And so we're going to say that our LIFO units sold is going to consist of the 3,450 at the $24 for the total of 82,800, plus it's going to consist of the 3,000 next most recent purchase, which were at $22.50, so they cost us a total of $67,500. We're also going to assume that we sold all 2,400 that we paid $23.50 for. So they cost us a total of $56,400. And then we're going to assume that we sold part of the ones that we bought on April the 8th. And so we're going to say, okay, these three numbers here, the $34.50 plus $3,000 plus $2,400, that equals $8,850. We know we sold 10,500. And so if we work backwards, that means that we've got another 1,650. If we subtract 10,500 minus the 88.50, we've got 1,650 that we would have sold that cost us the 23, and that gives us a total of 37,950. And that means we've still got 350 of the ones that we paid $23, and we've got 850 of the ones that cost us $22. So we do still have 1,200 on hand. So we add up these four numbers here, and that gives us our total LIFO cost of goods sold, which is going to be $244,650. Now here, we could take the easy way, and we could just say, okay, if the cost of goods sold is $244,650, we could simply subtract that from the $271,400 and say the difference must be ending inventory. But if we had made a mistake here, that wouldn't help us find it. Any mistake we made here would carry over into what we then reported as our ending inventory. So instead, we want to think about our ending inventory independently of the cost of goods sold, and then use that as a double check for ourselves. So the LIFO ending inventory, we're going to say, okay, we ended up with the 1,200 units. The units aren't affected by the costing method. Only the costs assigned to the units are. And so we're going to take the 1,200 units, and we're going to say, okay, the first 850 of those units were what we started with. That's the bottom of our pile, and we still have the bottom of our pile left. And so we still have 850 units that cost us $22 for a total of $18,700. And then we still have 350 from that next oldest purchase, the April 8th purchase, which were at $23 each. And if we multiply that across, we get 8,050. And if we add them together, we therefore get 26,750. Now here again, we want to add that here to our cost of goods sold to make sure that we do end up with 271,400. And we do. So our double check showed us that we probably did everything okay. So we then put in our ending inventory up here as 26,750. And we can fill in our cost of goods sold as 244,650. And we can calculate our gross profit as the 525,000 minus the 244,650, which would give us $280,350. So FIFO, first in, first out. We sold the oldest ones. We have the newest ones left. LIFO, last in, first out. We sold the newest ones, and we still have the oldest ones left. Weighted average unit cost, we calculate, first of all, an average unit cost that is weighted according to how many we bought of each at each different price level. And we multiply that times the quantity sold to get the cost of goods sold, and we multiply that same average unit cost by the quantity on hand to get the ending inventory. So how do we calculate that weighted average unit cost? We simply take the total cost of goods available and we divide it by the units available. And so in this case, we would take that 271,400 and we would divide that by the 11,700 units available. And that would tell us that on average, we paid $23.19658. We're going to keep a lot of decimal places because the more decimal places that we keep here, the more accurate our dollars will end up being. We're not going to round to the nearest dollar until we get to the actual ending inventory calculation and the cost of goods sold calculation. What we're going to do next is we're going to take the quantity sold, which was the 10,500, and we're going to multiply that times that 23.19658. That's going to give us a cost of goods sold using weighted average unit costing of $243,564. Then we use the quantity on hand, which is the 1,200 that we have left, and we multiply that times the same weighted average unit cost of 23.19658, and that's going to give us ending inventory using weighted average unit costing of $27,836. And now if we add together this cost of goods sold together with this ending inventory, so we're adding up these two numbers together, we do end up with our cost of goods available, the 271,400, that we use as our double check to make sure that these are probably calculated correctly. Notice if you had rounded here to 2320, you would have ended up with numbers that added up to something bigger than this because you allocated more cost than actually was available. So keeping more decimal places at this stage will help you avoid doing that. Okay, so let's write our numbers in. Our ending inventory again is 27,836. Our cost of goods sold is 243,564, which gives us a gross profit then of $281,436. So you can see that we will end up with different values for inventory on the balance sheet and for cost of goods sold and gross profit on the income statement. Because our other expenses get subtracted from that to arrive at our net income number eventually, you can see we're going to end up with 3 different net income numbers depending on which inventory costing method we use. How much different the figures are depends on how much price variation exists during the period. If prices are relatively stable during the period, the 3 methods will yield relatively similar results. The more the prices fluctuate, the more different the results could be. The key is you have to pick a method and stick with it. A company is not allowed to switch back and forth between these from year to year, figuring out which one gives them the highest net income each year, or the lowest, depending on what their motivation is, to pay less taxes or to make their financial statements look like they have bigger net income for their investors and creditors to be impressed by. We ask that they pick a method and stick with it. If they do decide to change at some point, then we put a red flag on their audit opinion and say they're prepared in accordance with generally accepted accounting principles, except that they changed inventory costing methods and therefore they don't have consistency. Remember, there's an accounting concept called consistency, that we want to be able to compare one period's results to the prior and future time periods. And if they change methods for inventory costing or some of their other accounting methods, we're not going to be able to compare those. So we're going to say that they're not consistent. Thank you for viewing this demonstration, and I hope you found it helpful.